All right, good afternoon. Welcome back here to Trader and great to have you aboard. I'm going to go off script here just a little bit this afternoon as we have a very interesting situation happening, and we don't see this too often in a trade that we are in, but it is something that I use to avoid certain trades, and I oftentimes will get some feedback. Hey, why care? Why bother? It's not that big of a deal. But we have something very interesting happening today. So let's go take a look at it. The price of an option, right? So an option price equals what? It equals, or I better said, it's a product of various factors. What are those factors? Time. The longer dated options, they're worth more. It's a product of price of stock, right? In the money, out of the money affects what the option price is. So the price of the stock there. Dividends affect it. It's a very small effect. Dividends, and then interest rate, which is a very small effect. None of us really even ever notice it. These are the four measurables. So an option price is equal to, the aggregate of these four variables. But if we were to take these four variables and put them in, we would notice that we would never get our option price. It would never match. They would never be the same. We couldn't figure out the option price just knowing these four variables. So what they call that last piece of the equation, implied volatility. They call it implied because it can't be measured specifically. So what they do is they take the option price and they subtract out the dividends, they subtract out the interest rate, they subtract out the option price, the stock price, and they subtract out the time, and that gives the implied volatility number. Now, as the implied volatility rises and falls, it affects the option in the position. For example, with Alibaba, we have an implied volatility, or trade Vega is kind of the term that's used, the Greek that is used, to say, look, when the implied volatility goes up 1 point, the position that we have will rise about $76, approximately. When the implied volatility falls a point, we'll lose about $76. You say, well, okay, not that big of a deal on a $2,000 position, and you're right. It's not. But as I mentioned yesterday, the Vega was about 4 to 5 points more than it should be, meaning that if it falls 5 points, we're going to lose what? We're going to lose about $420, $450 just due to implied volatility. That doesn't count theta. So we could see this stock go flat and lose about 30% of our position over 3 to 4 days. That's a big chunk. That's typically not a chunk that I'll jump into a challenge trade knowing that risk is there. But knowing what the market conditions are right now and what's going on, I decided I'm going to go with it. But something's happened today. The trade Vega here on Alibaba has created a situation where the stock is lower, but the option price is up on the day. Now, the exact price has to do with the spread and all of that as well, but you can see we're up $165 on the position since yesterday's entry, and let's face it, I didn't get a good entry price. And the stock is down about $1.60 from where I entered. So we have a stock that's down on us, and the calls are up. How does that happen? Well, that happens because the Vega increases. And that's what has happened here today. The Vega has increased. The implied volatility has increased from about 38 up to 41. It's put on about 3 points here. What's the big deal? Well, it's nice that it's adding that for us, but think about going forward. What does it mean going forward? If Alibaba were to rally $2 tomorrow, the implied volatility probably drops about 3 points, and we would be looking at an option value that actually goes down. The option value risk here has increased up to around 45% with this move, somewhere between 40 and 45%. That's a massive option risk. That's about what Netflix had on it yesterday that I was like, I don't even want to, go near it. And so it brings up the question. Do I take the position off and, live to fight another day? I mean, we're not taking a loss, not taking a big gain. It's not going to change a whole lot here. Or do I take the risk to hold it? Knowing that the risk to hold it is now more than just downside action in the stock. The risk to hold it, I need the stock to go up about $4 over the next 3 days to keep the option value about the same, given the fact that we could see this Vega come out. Now, the Vega doesn't have to come out. We can see the Vega continue to increase. Right, that is an absolute possibility here, and potential thing here for it. And so, bottom line comes down to, all right, do I want to take the risk or do I not? Right? Am I up for the risk? Do I find the risk warranted, or do I pull it off, live to fight another day, wait for the next signal, and go about it? Okay. I have taken, a very similar approach, with the challenge from day one. And with this being the first instance that we see of this, with this being where the market is, where the challenge is, I'm not going to take the risk. I'm going to opt on the conservative side, which is not necessarily what you have to do, right? I'm explaining kind of what I'm doing here. You can go out and hold yours if you'd like, do what you'd like with it, but I'm not going to take that risk. Why? Well, I don't want to be sitting in a position where I realize that risk and can't be putting as much money into the next positions. I would rather be in a position, just given how things are shaping up, given the fact that we're going to have some bigger moves. Once we see some of these signals come in, I would like to be able to put $3,500 into a position rather than potentially dealing with a Vega loss on Alibaba that now puts me in a position where I have to put $2,000 versus $3,000 into a position. So I'm going to opt for the conservative approach. I will mind you that I've opted for the conservative approach several times, and it has not paid off in terms of, well, you know what, we could have made more had I not been conservative. In the case of Disney, had I held it, we would have lost big. But in Starbucks, we would have gained more. In the case of Halliburton, we would have gained more. In the case of gold, we would have lost. We would have lost more overall. So it's one of those where feel free to make whatever decision you'd like to make. I am going to pull it off. I'm going to live to fight another day. I'm going to take the Vega gain because that's really all it is. This is not a stock price gain. This is an implied volatility gain, and I'll say thank you to the market and move on from there. So I am out at 835. Okay, I am out at 835 here on Alibaba. Okay. Let me make sure the alert goes out there. And this has nothing to do, but before, and I know I'll hear this, before, this kind of comes, this has nothing to do with a position being red or green. It has nothing to do with, have a gain, want to keep a gain. It has nothing to do with that. I would make the exact same decision if we were down $130 and the implied volatility inflated it the way that the way that it did here. So it is something that has to do with the ultimate value, has to do with the current risk reward parameters, and so pulling it off there at 835 and moving on. Okay, so I guess if we come back, we're invoking rule number 10, unusual circumstances. And we've talked about this. When a signal's triggered, the option's more than 10% the norm. I have the option to wait 2 sessions. We're looking at an option that's more than 25% the norm, not 10%. That's how inflated, it is right here. So pulled it off and moving on. So let's see where that puts us. That puts us back in cash, which is not what I want to be. I would much prefer not to be in cash, but 8:35 here, and the close date is 3/5 p.m. And close. I am going to note here. Stock price lower than entry, but option gained due to increase in implied volatility. So like I said, we don't see this very often. Especially in a trade that we're in already. It's more visible we generally see it in trades that we're looking to get into and go, whoa, that's, really inflated. But, trades that we are in, I typically do not see it. That said, this is not a first for the challenge algorithm. Back here, let me pull it up here. Let's come back. Let's go back 2 years. That should show us, right in here. This is where we saw some increased volatility, and we saw some increased volatility in stocks. And it was a time where the challenge algorithm did not perform very well. And it's one of the reasons why the put side is a little tuned a little bit differently than the call side, because in this downward move, the puts got hammered because the algorithm was triggering puts, on these types of days here, and getting 1 day of move, but it wasn't a 2 average true range move, then getting a reversal and kind of getting, taken out on that reversal. We got trend moves right here on the put side, taken out on the reversal. And so just not a lot of follow through to the moves. And with the option prices tending to be very expensive, we had to tweak the algorithm a little bit, and we've been very happy with how it's performed since. But it's one of the reasons why we see more calls and fewer puts. That will change, if the overall environment changes for the long run. But, we saw this happen with some of the option pricing during this time. And, we saw some of the options that we got into actually increase in value, even on the down days in the market. When we had some calls, we saw some puts, lose significant value to the option, even though the stock went down just a little bit, but the implied volatility came out. So we saw both sides of the equation during this time period back in the end of 2018. And it's one where, as we put the challenge algorithm together, we knew, okay, this unusual circumstance, we'll just have to make a judgment call in the meantime. And, it's just one of those circumstances where rule number 11 and rule number 10 come in to allow me to do it. But again, this is still a stock that we could see go and hit its price targets. It still has a very solid technical element to it, and one that I would not be surprised to see move up to that 225 level that the algorithm is triggering it for. And this is something where I will leave myself open to be able to re-enter tomorrow morning, or to re-enter tomorrow afternoon should we see the option values normalize, to a much more significant degree than what they are at the moment. Okay, so hopefully that helps in terms of just understanding how implied volatility works. We don't normally get that great of a real-time look at it. A lot of times when I'm in a position and it starts to bleed, people will call it time decay when the majority of it's implied volatility coming out. They can oftentimes be confused there. But on a day like today, it's really evident, what the implied volatility does and how much it can affect. And the implied volatility for Alibaba has not moved all that much. It is something that can move a lot more. And so, we're just seeing a 3-point adjustment. And what that does, basically it is a 3-point adjustment has overcome a full delta, right? A full delta here on the position. So the full 155 plus, a couple Vegas there. So it's one that's had a pretty significant effect in terms of the option value price and in terms of the risk ultimately going forward. Okay. As far as the overall market goes, we still see the metrics. They're still bearish. Market vibe is still in a bearish position. I mentioned yesterday at the close that if we saw, a little bit more improvement in the metrics here today, that we could see the market vibe go bullish. Obviously, that isn't happening. And so the market vibe remains bearish, which just tells us, hey, we're still going to see a lot of dips. We're still going to see a lot of rips. And, those are going to be, part of the market that that we are involved in. As far as any sort of real bottoming on the day, nothing really. I mean, just really volumes, nothing that is all that significant. We have seen the banks kind of bottom out. So if you look at JP Morgan, while the market's been hitting new lows, the banks haven't. Which is really interesting. Most of the selling is coming into the tech and industrial areas. The areas that kind of held up early on this morning is where a lot of the afternoon sell has come. So UTX has been bleeding all day. Boeing bleeding all day. Triple M a little bit different after yesterday's news, but the sector as a whole, kind of bleeding all day, while the banks kind of holding up. Visa trading like a lot of the techs that have just been bled, here throughout the day. And so not a lot of real change. Not something where we look and go, oh, okay, the market is materially different today than what it has been, and the norm would be for it to to continue this way longer than than just a couple days. But we'll see how it plays out. We'll go after signals as they come in. But, as I explained, pulled off Alibaba, and we'll live to fight another day. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow morning. Take care.